Christopher Naismith. I'm the CEO and founder of a company called Audette. My background is in building science. Realistically, it takes one person full-time just to submit numbers and collect those numbers.
Why would I pay for an ongoing software license when I can just go hire somebody to audit the individual building I want to audit?
Energy auditing came from a set of standards that were developed by ASHRAE starting around the turn of this century. And they've always, throughout their history, had this focus on energy efficiency. Canada, we just axed our carbon tax 2 days ago. And so that changes the fundamentals of every one of those business cases we put together. And everybody has to go back. And if this were static audits, all of that intelligence would be out of date and you'd have to go back and re-audit everything again.
Joe, good to see you. How's things?
Yeah. Hey, Lewis. Good. Everything's good. Another good week.
Good stuff. I have an interesting stat to start this podcast. Did you know that individuals in sustainability spend up to 70% of their time reporting and compliance, 20% of their time dealing with strategy, engagement, training, development of these individuals, these real estate portfolios, and only 10% in terms of decarbonization implementation?
It's a good stat. I've heard at least other stats similar to that, so I'm not at all surprised. But that really is a good way to tee up the guest we have, who's Chris Naismith from Audette, founder, CEO of Audette. Audette's a really interesting company because they really focus on, I wouldn't say the 10%, but they focus on what you should be doing with more than 10% of your time, which is actually decarbonizing the assets. And to your stat, I've certainly talked to any number of sustainability leaders across real estate who talk about reporting season, talk about how much time they're spending on reporting, talk about we just don't really have a lot of time to do anything beyond that. And I think what that seeks to do is add some data, software, some automation, if you will, to the process of identifying opportunities to decarbonize your real estate. The one stat you probably picked up on a point that Chris made, he was talking about how it's a little bit like capital planning, looking at it through what I would say a decarbonization lens. Chris had a different phrase, but I think that's exactly right.
Yeah, and I think that's a good point. He was coming from a different lens. It's quite refreshing, really, because you see the doom and gloom with what's going on within commercial real estate. Obviously, we're recording this now at a time where there's jeopardy with what's going on with the GSA and the EPA, and just commercial real estate and other assets outside of data centers aren't necessarily booming. So it's nice to hear him validate that, because you often see people in the space who are in the space maybe inflate where we're at as an industry for selfish reasons, and I completely get that. So lots to take away from here, and I think we should tee up Chris joining us.
Yeah, a lot of good nuggets of information here, so I hope everyone enjoys it.
Welcome back to another episode of The Download with Joe. Joe, I was looking back on some of the previous ones we've done and didn't realize that we're on episode 25 now.
It doesn't seem like we've done nearly that many, but I guess that's a testament to our dedication, our love of the space.
Congrats on the milestone.
Yeah, appreciate it. So, yeah, Chris, you're number 25, right? And this piece that we've done over the course of the last, 7 or 8 months has evolved. Some things have worked, some things haven't, but I think what has worked throughout is bringing on industry leaders who have a unique perspective, whether they within their leadership team or founding team, or they're just experts delivering technology or selling technology. So we're super grateful to have you on. I know it's an incredibly busy time for everyone at Audette, but I guess for people who would like to know a little bit more about you, feel free to give everyone an introduction.
Sure. Well, thank you very much for having me. I really appreciate that. I'm Christopher Naismith. I'm the CEO and founder of a company called Audette. My background is in building science. So I started in civil engineering, but then very quickly realized that I needed to learn electrical and mechanical and automation and all the things that really intersect to drive performance in our large buildings, because my mission is to help owners to decarbonize through retrofit. I started my career early on as a consultant in this space, really helping owners to do their energy audits and spec out construction projects and oversee those projects into measurement and verification. Saw a lot of really interesting projects make their way into buildings end to end. And in the course of doing so, realized we are not doing this nearly fast enough or at enough scale to have an impact on what is ultimately a crisis as it relates to carbon emissions and climate change. So I've sort of pivoted my career to leading a software company that does the same thing, but for hundreds or thousands of buildings at a time.
Yeah, it's great. Would you say, Chris, there's been a focus and there's been a lot of news even recently about the challenge or the opportunity, depending, there's a challenge. Buildings use a lot of energy, 40, 45, even a little more percent of total energy consumption. Emissions obviously kind of flow from that. And then this really big focus on reporting and disclosures and how I saw something, I think it was an IBM survey, and IBM owns a couple assets generally in this space, that said most people who are a sustainability leader, they spend all of their time on reporting. And so the takeaway there is, this is not a quote, I'm just kind of paraphrasing it. We don't have time to actually decarbonize our assets. We're spending all of our time reporting on the performance of our assets.
It certainly is a problem. I sometimes ask that question, like particularly when they're in reporting season, how much of your time do you spend on this? It's usually somewhere on the order of half the salary of one FTE spent just on submitting reports. And then, there's all the shadow work that goes into managing the stakeholders. And so realistically, it takes one person full-time just to submit numbers and collect those numbers. And that's inherently unsustainable. And that's only for the cohort of building owners who care about that stuff. So if you sign up to care about that stuff, then you are also committing yourself to a bureaucratic hellscape of data collection and reporting. It's not super compelling. And so we have to think about, how do we move past that? How do we move into implementation? And one of the things that we need to address is, how do we originate all of it? Because it's one thing to understand your current emissions footprint or your current environmental footprint. The other one, it's a very different thing to know what to do about it. And so how do we get people to that place of knowing, which is really just analytics, as fast and cost effectively as possible? And fundamentally, we need to have a transition plan for every building on the planet, or we're never going to get there. And that, I think, would free up a lot of folks' time from this sort of understanding our current state to thinking about and executing against our future state.
Yeah. This point on reporting, I mean, part of the reason there's a lot of time spent on reporting is there's multiple different protocols and standards and kind of de facto regulations. So the framework is fragmented, and that just means a lot of work. But you seem to be implying that the other side, we want to decarbonize the assets, not just report. If that's easier, simpler, more data-driven, more automated, even if you don't have a larger share of time to do it, you can do more. Is that a fair characterization?
Yeah. I mean, if we think about why we're doing reporting, it's mostly just for sake of transparency. It's so that the folks who are putting, there's over $100 trillion pledged to the UN responsible investment principles. Like, they need to be able to understand where that money's going, what it's being attached to. Like, I get that. It's fiscally responsible to want to know how it flows and where, what impacts it's having. Fundamentally, it's not like we're not actually reporting on that. We're mostly just reporting on our current state and assuming that all of the action is going to happen in between, that every time we take a snapshot of our current state, we are going to see velocity. That's actually not true. We're not actually making much improvement. A different way to think about it would be, what if we knew the transition strategy for every single asset, be it a building or any other piece of infrastructure, and we could track those projects? Like, we knew what we had to do, and we could report out on whether those things happened. And when it comes to buildings are expiring all the time. Every single piece of a building, be it a window or a piece of HVAC, has a lifespan somewhere in the order of 20 to 40 years. And so somewhere between 3 and 5% of our buildings are just turning over every single year. Those are our projects. Those are our opportunities to incrementally move all of our infrastructure towards a lower carbon state. And so it is really just a capital planning exercise. And if we were doing that well and understanding what we had to do and demonstrating that we were doing it, it would kind of take care of reporting. You wouldn't need to be you would spend all your time on capital planning and actually driving projects forward, and then just reporting on your progress there, knowing that that is having the impact that's intended.
Yeah. There was a post, I think mid 2024, I wrote focused on what I called enterprise decarbonization analytics platforms. I mean, there's probably going to be a term of art, but decarbonization platforms for real estate, think of it that way. And I noted exactly what you said, that think of capital planning with a net zero lens as a way to think about, what are these solutions actually trying to do or actually doing? And mapping to the capital plan, to your point, is I think a really good way to think through this.
Yeah, I think we might even expand that definition a little bit into modernization. Like, we've all collectively understood that more modern assets are more valuable. There's a strong correlation there. And I like to ask the question, what if modern assets are smart, they keep people happier more easily, and they happen to also be lower carbon, and they're more resilient, against weather conditions? I don't think anybody's going to really disagree with any of that in principle. And so, and we already know how to modernize assets. People are repositioning assets all the time. If we just work the factors that we collectively agree are better future conditions into those exercises, we will get where we need to go. But if we treat it as a separate, distinct sort of sidecar activity to normal business, then we're never going to get there.
What stage would you say, or where are we at on the cycle? Because from my perspective, I'm always keen for people to tell me I'm wrong. most times I am. But is energy auditing the first stage? It seems like we've been doing that for years. Obviously, you've spent a lot of your time prior to Audette doing that as well. And then tying that into software and reporting is the next stage, because it seems like energy auditing for a lot of owners and also just firms out there, whether they're engineering consulting firms or similar to Audette, that seems like table stakes. Like the change management education piece isn't required there because everyone knows the importance. So where are we at in terms of like the next steps to actually getting to decarbonization?
It's a great question. It's worth maybe diving into history just a little bit to think about like where energy auditing came from. Energy auditing came from a set of standards that were developed, at least in North American context, by ASHRAE starting around the turn of this century. 1998 to 2004 was sort of when the first version of the standards were published around ASHRAE levels 1, 2, and 3. And they've always, throughout their history, had this focus on energy efficiency. And I think it's great. As an owner, you should care about using energy more effectively. You should think about where there are anomalies, where you have inefficiencies, and fix those. That's an exercise in conservation. Great. Decarbonization is actually an exercise mostly in substitution. It's about so if you think about energy efficiency as taking something from outside its idealized design conditions, and those design conditions can change throughout decades. Equipment gets more efficient. There are better smart control systems. So the goalposts change a little bit and you can get your building from outside of those conditions inside those conditions, or maybe beat them a little bit if you're really smart. But you're only ever going to get to, that as a base state. If we want to get to a decarbonized base state, we have to think about substituting equipment for things that use lower carbon fuels, or else it doesn't really matter how much energy we're using. If we're not using zero carbon energy, we're not zero carbon. And so the standard has evolved slightly, but it's still kind of hemmed in by this idea of an energy audit, where I like to think about it as carbon considered capital plan. Really, what you need to hire somebody to do is come in and say, okay, here's all the things that need to happen to your building anyways. In order to drive this to a more modern, lower carbon state, we are going to need to do this project and this project and this project. And in doing so, we should also insulate all your piping. We should also make sure that the building controls are smart. We should also think about additional revenue generation through demand response. There's all sorts of vectors of additional opportunity, but they are secondary to the exercise of substitution that is inherent in decarb. So I do think, to your actual question, there's a lot of folks who have normalized this idea of an energy audit as being the first step. I actually think that might be our barrier. It's $20,000, $30,000 to do one. It takes months to turn around. And so you see even the most carbon committed groups, like single digit percentage of coverage of their energy audits. And that's never gonna, they're missing massive swaths of opportunity for lack of having that intelligence.
When you say the single digit coverage, you just mean if I have 100 million square feet, I probably have only audited under 10%.
Yeah. I'll give you an example. So we work with a large real estate fund whose name you would recognize. Their most carbon committed fund, they have a bunch of Canadian pension funds invested in it, has a mandate to have audit coverage of the portfolio. Their annual target is 20%. So they would have full 100% audit coverage every 5 years, which is a reasonable cycle, but they were struggling to hit even 5% just because it is slow and it is expensive. And I would argue that 20% is not nearly enough, given that there's going to be so much of your building stock that is turning over every single year. And that is the most carbon committed fund in their stable of investment vehicles, which are many more than that. And so that's where we're at with energy auditing, is most people don't know anything about their buildings or what they have to do. And the ticket to buy in is at minimum $20,000 for one building. And no one except for the most committed folks are going to pay that.
Right. And that actually is an interesting point, and something we talked about when we were prepping for this interview or this podcast. One of the rebuttal or objections you often hear around software in general, like software as a service for commercial real estate, but I've also heard it specifically for a decarbonization platform, is why would I pay for an ongoing software license when I can just go hire somebody to audit the individual building in which I want to audit? That's a really good rebuttal, what you just noted, that actually probably be advantageous for you to use a portfolio software tool.
Yeah, if only for the cost of it, is that you fundamentally need to be in the room for every capital decision. And that includes normalized capital planning, quarterly budget planning, annualized, but also every time anything fails, because your operators are going to go out and buy something from Home Depot or wherever their list of suppliers is guaranteed going to be the thing that you had in there already. if you wanted to leverage that point to do something different about your buildings, you've missed that window for 20 years. And so you just fundamentally need to understand how all your buildings are operating. Now, granted, you can take that snapshot once every 5 years and probably be fine and build that plan, but people can't afford to do that in a traditional approach. The other piece to consider is how quickly everything around the building is changing. The cost of energy, the grid carbon intensity, the tax and BPS fine structure. Canada, we just axed our carbon tax 2 days ago. And so that changes the fundamentals of every one of those business cases we put together, and everybody has to go back. And, if this were static audits, all of that intelligence would be out of date and you'd have to go back and re-audit everything again, because what you're relying on the auditor to do is to build those business cases one time for you for a hefty fee.
Yeah, that's a great point. Yeah, one of the points you made earlier, this maybe objection rebuttal around, I don't have the money to audit my buildings, but I don't want software because if I wanted to, I would just go audit my buildings. That raises a bigger question, and I'd love your perspective on just how big is this opportunity? It sounds like the firm in Canada that wanted to get 20% of its portfolio audited per year. That's maybe like the stretch goal. My words, not theirs, of course. But I take away from that, a lot of portfolio owners are not even, and they're only hitting 5%. So, it seems like the opportunity here is massive in terms of needing to do more than just an audit every couple of years on an ad hoc basis.
Yeah, it is fundamentally about investment intelligence, really. We have historically treated buildings as fairly static, knowable objects in the real world that we can do good financial planning around. The truth is that it has fundamentally changed, particularly in the last 5 years. The global economy has changed fundamentally. The market views on carbon, the cost of carbon, what resiliency means in the face of increasing weather patterns. And so a good investor needs to have an opinion about what's going to happen and to be hedging against risk and capitalizing on opportunity. And if you don't understand there's all the visible stuff like, we could put marble in our lobby to attract
aesthetics,
higher rent roll, but all this infrastructure costs are largely hidden to them or using very archaic like-for-like replacement models that are going to not serve them well into the future. So when we think about it that way, if every large property investor needs to have intelligence on how the climate and the conditions around carbon are going to force them to make different decisions, then it's every building. Every building needs to have a decarbonization, or let's call it a transition plan if you don't like that word. It's just the economy is changing. You need to adapt. And if you don't know what adaptation looks like, you're going to not be as good an investor as your peers.
And would you say, I was going to add a quick follow-up, sorry, Louis. Do you see the opportunity different between we're a commercial real estate firm, we invest in the buildings as our business, and then we lease out the space, versus we're a large company that has offices, versus we're a public institution, university, hospital, city, something government? I know you may not focus on all of those asset classes or industry types, but I'm just curious as it relates to the opportunity, how you think through differences and nuances there.
Absolutely. There's certainly different. I think that's one of the most important points that we as an industry need to internalize, is that we tend to think of buildings as, particularly like commercial buildings, kind of a monolith. It's really, an office is an office is an office. It doesn't matter who occupies it. And that makes sense from this position of like the control system or the HVAC system. But the model of ownership can vary so drastically. And that is really where the incentive lies to do something or not do something fundamentally different to your building. So I used to work in the municipal and university school healthcare sector. I'm not particularly worried about that industry. I think they'd have enough motivation, resources, pressure, access to capital to do what they need to do. That's, ESCOs are pretty heavy footprint there for a reason, because there's capital and motivation. The one that I'm most worried about and the one that I focus most attention on is the large investment cohort, because they're fiduciary duty kind of bars them from doing anything. They're legally not allowed to do things that are not in the best interest of their shareholders. And right now, the global perception, though it's not fundamentally true, is that pursuing decarbonization is counter to that in a lot of cases. And we have to, it's really just about bringing the analytics to bear that demonstrate that that is not the case, that there's actually competitive advantage to be had. And then that is going to catalyze a whole bunch of opportunistic capital deployment. And then that middle piece where you've got occupiers, a lot of them are in those buildings. They don't have a lot of control. They can sometimes negotiate some leverage through leasing, but for the most part, it's the owners, the asset managers who control about 10% of our global property value that we're focused on, because they represent a significant leverage point and also just a really sticky part of this whole equation.
It's a Great point.
I was going to ask on the point of the opportunity. Obviously, there's optimism between us three, right? Like we're in the space and we want to see progression. From an outlooking perspective, is the opportunity too big? For example, there's just too much to do and potentially that's where you see a lot of stagnation or decisions not being made?
Yeah, I don't think it's too big. It's a great question. I think that it is big enough to be overwhelming. I think there's a lot of things that need to happen. It's about over $10 trillion worth of tech needs to flow into this space. I think there are some very logical fundamentals that we need to deal with in order for that to happen. And then I think once we get the flywheel started, it actually is going to kind of take care of itself. Because one thing I trust capitalists to do is to leverage opportunity to make money. So if we can create an alpha in decarbonizing real estate, so many people who are positioned and ready to take advantage of that and very agile in how they reposition their business models and spin up new funds and access capital. The problem right now is there's no data to support the idea that there is alpha to be derived, other than in a few key markets that are largely saturated anyways. So the fundamental problem, I don't think, is about inventing any new technology or figuring out how to sell that technology better. It is about changing the business models of how we do underwriting in large asset management to consider the deployment of those technologies. There's all sorts of things that investors do that are semi-rational, let's call it, like the marble example. I'm going to ship this particular type of marble over from Italy and install it in my lobby because I believe it's going to get me 10 cents more per square foot in rent. It can be material, but there's probably a bunch of other ways you could do that, or you could drive down 10 cents on your utility bill. And so we just have to build a compelling enough business case that modernized low carbon assets are more valuable and that you can meaningfully capitalize on that, and then technology will start to flow.
Yeah. You raised an interesting point. When I think of a capital plan and I think of commercial real estate or the investor cohort, oftentimes the capital plan is something that you're doing at that transaction point, right? We're going to buy this building from another investor. We're going to do as much diligence as we can to build out the capital plan. And they probably know what their hold time period is. So they probably know if we spend X over this period of time or upfront to hold the asset, this is what we expect to get. So the return. And that's just real estate investing 101. But how does that impact what you're offering? Because you could argue, and I've heard this before, we have this asset, we bought it 3 years ago, we have a capital plan. There's no room to adjust the capital plan because we already have underwritten on the basis of, we need new chillers, or we don't need new chillers, but we need new air handlers, or cooling tower needs to be rebuilt, just to give some HVAC examples. I mean, there's plenty of others. Just interested in your thoughts there. Yeah.
It's a great point, and it is fundamentally, I believe, one of the biggest challenges to decarbonization is this idea that you have a business model attached to every single investment, and deviating from that business model is risky business. It becomes riskier the closer you get to the end of your hold period, and the process through which we have traditionally acquired these properties has almost never included even an energy efficiency audit, certainly not a decarbonization study, for a couple of reasons. One, it's super high pressure. You put down a deposit, you have about 2 weeks to collect all the information and make a decision, maybe a month, and you get 10 stakeholders together around a table, many of whom have a lot more power than the ESG leader. And so I haven't heard of anybody who turned down a deal because it had, even if they knew that there was a bunch of carbon exposure or energy efficiency exposure, that they didn't do it because of that. And part of that is that you've already by the time you put down a deposit, you've already you're just looking for reasons to not buy. But if you were to take a lens of maybe a value creation, so let's take, I don't know if they'll mind, Galvanize Real Estate, for example. Their goal is to fully decarbonize every asset they buy within the first 3 years. In order to do that, they have to be pretty sure that they can do that. And not every asset can do that. So they have to then think about shifting their analysis way before that, where they put the deposit down so that they won't even enter into a business model where that's not possible. And that's really where we have to get to, is understanding if we are going to fundamentally invest in a property, is it worth it? And can we do it? And price that into the transaction well before. And that's something that fundamentally needs to change before we can actually get a bunch of cash flowing towards decarb.
Yeah, that's a great point. I guess a kind of a wrap up on some of what we've talked about. Are there other barriers points of friction in terms of scaling decarbonization broadly across real estate? I mean, one that pops into my mind is when I think of commercial real estate, it's extremely fragmented, right? Like the largest, at least in the US, I'm sure the dynamics are similar in Canada, probably similar in Europe. Even the largest owners of commercial real estate have a very small share, 1%, 1.5%, but there's a lot of very big commercial real estate owners that maybe have 0.5% of the tenant occupied office space if we just focus on office to start. Is that a point of friction or a point of challenge of just scaling decarbonization? Are there others we haven't discussed?
Yeah, it's certainly, from a volume perspective, something we're going to have to tackle. I think fundamentally these players do drive markets. They disproportionately hold our complex, smart keystone buildings in, you'd be hard pressed to go downtown in New York and find a building that's not held by, something of note that's not held by one of these large groups. And so we need them to be a player at the table. And they're the ones who are fundamentally setting the valuations on these properties, driving cap rates, driving the benchmark for leasing. That is, you don't have a lot of that leverage as a mom and pop investor. You certainly don't even really care about it that much if you're in the institutional sector. So I kind of tackle it from like, this needs to be true. And so we have to deal with that. And that this starts to catalyze a flywheel that drives the rest of the market towards a certain type of behavior. Then the problem becomes like, I would love for the problem to be, we don't have enough tech to deploy into these opportunities. Right now, we don't have enough opportunities to deploy the tech into. And that is a recipe for not getting anywhere.
Just on that point, Chris, how do you then change that? Because you mentioned something before about the need for trillions of dollars of capital around technology deployment. How do we go from where we're at now to actually getting large-scale deployments of Audette and other companies' technology to actually solve this piece and be on track for decarbonization?
Yeah, fundamentally, I believe it to be about attaching value and risk to these opportunities. So we've gotten pretty good at attaching how much money you're going to save on your utility bills to most technology. So that's already sort of a known part of the equation. We have lots of technologies where this has happened already. It's hard to go out and procure an incandescent light bulb these days. That wasn't always the case. We're starting to see that in modern motors and onboard control systems. And so this is going to happen by like pure economics. And then there are things that take a little bit more conviction about the future to want to deploy. Some smart building control systems fall into that. You can have a fairly rudimentary control system, or you can have something that has FDD and AI built into it. And that's going to be a little bit more like, hey, well, I believe that tenants are going to really value this thing. I can treat it as an amenity play, and I can kind of lump it into that category of a lobby upgrade, not just an energy efficiency project. There are things as it pertains to carbon that are material to future cost. The one that I like the most is we have a whole bunch of jurisdictions in the US that have building performance standards emergent. These fines are substantial. Not all of them are going to persist into the future, but a decent chunk of them are thousands of dollars a day in some cases. And so those things will start to drive behavior around whether you choose at the time of replacement or refurbishment or turnover one piece of equipment or another, because you can look at the life cycle fine exposure. And so that can hit your like operating bottom line, but it's starting to creep into what is the next owner going to think? What if I try to bring this to market and I haven't dealt with that? And whether or not I'm directly exposed to fines, they're going to look at that and they're going to say, well, in 5 years, this building is going to cost me $200,000, $300,000 more a year to operate than this building across the street that looks exactly the same, but has made different decisions. And so there's this liquidity risk that's starting to creep into the minds of investors. That is things that we can then attach to the capital projects decisions that they make throughout their own hold period.
Okay, interesting.
Yeah. When you look at the landscape, you mentioned earlier ESCO's obviously well-established business model, really focused on the MUSH market, municipal, university, school, healthcare. You have reporting tools that at least give some visibility. How am I performing? How are my assets? What's the carbon impact? It does feel like there's not a lot of solutions out there that really will get you to, here's your capital plan to decarbonize. Here's the path forward. But what's your take on what's really missing and where Audette fits? And I ask that mostly because I think there's a lot of other companies that at least message, oh, we can help you with your decarbonization plan. If you're an ESCO, well, we can fund the projects, though a response might be yes, but is that the best place to put that dollar or those dollars to work? But from that, of the array of solutions we have, where your niche or your wedge is maybe and what's missing in the market?
Yeah, so I think there's really two things inherent in that. The one is that a lot of folks who will tell you that they can tell you what to do about decarb are taking one of two approaches. One, they're going to show up to your site and they're going to figure it out and they're going to present you with an audit. And great, you've paid somebody a lot of money with a stamp to come and do that for you on a single asset. I would trust that. The other one is we're going to take limited information and give you a decarb plan that is predominantly driven by energy data. And that fundamentally, I think, is flawed thinking. I think that you can tell something from energy data or from like top-down reporting data about what to do, but it is going to be limited and guaranteed by the time you get it in front of your engineering team, it will have largely fallen apart completely because it is really dependent on what the pieces of equipment are in the building and what needs to happen to them. So I agree with that first approach, the energy auditing approach, which is what I would call an equipment first approach, is thinking about what are the systems that we need to replace. Now, in my job as an energy auditor, I came to understand that I could sit in a lobby with a property manager for 5 minutes and have a conversation and largely have figured out what I was going to recommend by the time I'd gone through the boiler room. Buildings are an intersection of knowable design patterns that once we have the appropriate data about buildings, we can attach projects to them. And the other thing that I came to understand is that a lot of this data exists within organizations, but in really messy, unstructured ways, from computerized maintenance management systems to the brains of operators. And one of the leverage points that we've been given in the last 5 years is the ability for large language models to take that unstructured data or take conversations with operators and turn them into structured, knowable data sets. And then we can use the understanding of building scientists and engineers to attach design patterns to that. So, for example, there's a cooling tower on the roof. Well, it's rejecting heat from something. What is that something is going to be dependent on what the building's being used for, when it was built, what the roof looks like, what the basement looks like. And once you know those characteristics, some of which are inherently much more knowable than a nameplate in a basement somewhere, you can attach the most likely project to this asset that gets you there much, much faster than having to have somebody come and take a photo of the physical object.
Yeah. I had one kind of follow-up question, and then Lewis, if you have anything, we can also do a couple of rapid fire questions, which we've kind of started integrating into these. But you mentioned CMMS, computerized maintenance management software. Sometimes firms are kind of transitioning that brand name or that term of art to IWMS, Integrated Workplace Management System. But it's interesting because I've heard this is a bit of a multi-part question, but I'm just interested in your feedback. So I've certainly talked to firms that do audits, do ESCO performance contracts, and sometimes say, like, for example, the asset data is really bad, right? We know there's a chiller. We don't know a lot about the chiller. We know it's old, but we don't have an easy way to take a serial number and turn it into information about the asset. You could argue the CMMS might have some history there of it was repaired on this date. It was then repaired on this date. It was then repaired 2 years later. This is the repair. I've talked to some folks in this industry who have said, oh, that asset data isn't actually the unlock that you might think it would be for decarbonizing assets. Though maybe that's still up in the air. Different people have different views. But then you look at some of the industry leaders in our space, and there was maybe a year ago, 4 big firms made acquisitions of what I would generally term CMMS or IWMS companies. Trane bought Nuvolo, JCI bought FM Systems, Siemens bought Brightly. Schneider didn't officially buy, but I think they own now 90% of Planon. And there's probably a lot of reasons that they're doing this, but you could argue that there's an interesting angle. You also have a couple of CMMS and facility management software companies that have made acquisitions of energy and sustainability software. One notable example, Tango, an FM platform, bought Watchwire. MRI bought earlier than that, I think eSight Energy, another firm. So there's a bunch of interesting moves that you could put the thesis to be, if you have a lot of energy and retrofit opportunities, you want more asset data and facility data. If you have a lot of facility and asset data, you want a solution that does energy and sustainability. So I just teed all that up. I'm just interested in your perspective on the market landscape, those market developments.
My observation is part of a broader consolidation to try to make workflows and data collection better. To like your first point in this conversation is it sucks. Like data collection sucks. It takes a lot of time, and we want to make that easier. So that's a painkiller. I agree with that. I think we should be trying to do that better, and fundamentally asking, like, what is that set up to do? In the case of maintenance management systems, it is to run maintenance workflows and increasingly different, tenant satisfaction workflows and all sorts of other workflows better. I think that's going to be a really interesting evolution as we layer large language models onto that. The tenant satisfaction one's a really interesting one. Now you can have folks having like conversations with the data, conversations with the asset effectively, and you can actually fill in some of that data through parsing the nuances of that conversation. So I think we're actually going to see much more robust workflows, or like just infilling things that when we say data is bad, it just means it's gappy. It just means it doesn't have continuity. It doesn't have accuracy.
Maybe not context either.
Yeah, it doesn't have sufficient context. But I think large language models can be really a boon to that if we integrate them correctly. And so I think we're going to continue to see that type of consolidation, and really just in name of like supporting those workflows better, which is really mostly about supporting the operations of facilities. And we'll see a similar thing happen on the energy and carbon data for investment management as well, which is really the space that we play in.
It's great. It's a space to watch without a doubt. I mean, it's something I keep watching in the newsletter as well. So yeah, thanks for the insight.
Yeah, and I think just to follow up on that, Chris, you mentioned some changes within Canadian government which may impact the space. There's been a recent change in administration on the US side and headwinds with the GSA and EPA, maybe some ripple effects across just broader real estate assets or markets. What do you think this year, as in 2025, is going to look like for the space?
It would be disingenuous to say that I don't think like these headwinds are going to hurt the decarb industry and the energy efficiency industry broadly. What they're really going after is the incentive structures for behavior change. They don't want this behavior change. Fine. We're going to like dismantle the things that we're trying to get people who are on the margins to do things. It's weakened the marketing value of ESG broadly. Like there's very little impetus for a company who was using this as marketing leverage to do so anymore. In fact, there's probably a disincentive to do that. What it doesn't change is the investment fundamentals. So what I expect to see this year is a lot of folks backing out of commitments that they made, a lot of folks, leaving the Net Zero Asset Managers Association, a lot of folks kind of backing away. But truthfully, those folks were in it for marketing purposes and were never really going to do much with that anyways, beyond just attract money to deploy it under their traditional business model. And then we're going to see a lot of people who, now that the landscape is clear, double down on their investment in modernizing assets in a low carbon way. So, none of the sophisticated leaders I've talked to at any of the big asset management shops are worried about this at all. They just see it as more opportunity for them, more opportunity to double down on their existing investment models, many of which were cemented when they spun up this fund 3 years ago, and they just have to play out the cycle. But they're building new funds as well that capitalize on this as a value add opportunity. We might not call it brown to green anymore. We might call it like dirty to clean, but it doesn't really change the fundamentals that there's value here to be created, and they'll continue to do that.
One final question on that point. With ESG over the last, 18, 24 months now becoming, you said it there, but different context, almost a dirty word, which is strange even saying it, but that's politics, right? Do you see more companies that play in that specific ESG space, whether it's a platform, specific technology, moving over, and similar to companies marketing themselves within those associations that you talk about, then transferring over from a marketing purpose to become decarb platforms or decarb tech?
Yeah. So this is, I think, where reporting solutions are super vulnerable to market conditions like this is, if nobody cares, then what are you reporting on? Like the value of your solution is diminished by that. Whereas if you're helping to drive some particular action and that action is persistent in the face of these headwinds, then you're going to be successful. So I think we're going to see a bunch yes, some people reposition, but some solutions that were fundamentally not designed to drive that action struggle in this market. And those who are fundamentally designed to drive economic activity will do well. And so we're going to see a bunch of people reposition. And even, let's be honest, I think most of the ESG backlash is predominantly around the G, and some of the S. Is the E part, the environmental part, is starting to get hit by some of the changes in the EPA, but predominantly, like, there isn't a lot of people that I'm talking to these days who disagree that we should be building more resilient assets in the face of a changing economy and a changing climate. That just feels kind of fundamentally baked in at this point. We just have to think about how we position it into this new business context.
I really appreciate the honesty there, because sometimes when you see posts on LinkedIn or just reports of optimism within 2025, and then you're hearing and have conversations with leaders, you just think, how do they both marry up? It's been a really interesting time for you with Audette. I think last time we spoke, there were a lot of exciting updates, pilots were moving ahead, and you're growing as a business. What does 2025 look like for you guys?
I'm really excited about this year in that we have a mandate from a bunch of really exciting partners in the market to really start to support more broadly underwriting and capital planning. So we've sort of got this entry point in decarbonization, helping people to understand their levers of opportunity there. But it's brought into the conversation a lot more questions like, how does resiliency impact this? If I need to, move my electrical systems or provide backup power for business continuity, how might I also use that to decarbonize my assets? Or I want to reposition this asset because that there's a growing segment of distribution and warehousing that I want to take part in, but what do those tenants care about, and how might I think about capital projects that support that activity? So getting more fully integrated into the asset and portfolio management conversations is where we're going from a product perspective. And that gives us a lot more sort of breadth of in the market and ability to support. I'm always going to be committed to decarbonizing assets because I think that is fundamentally what we need to do to protect value. But to be brought into conversations where that might be a co-benefit to something that is fundamental to real estate investing is really an exciting space to be in.
Yeah. Chris, do you have time for 2 or 3 quick fire round questions? We just like to ask a couple consistent questions like a lot of podcasts. And I think I forgot to send these to you, but they're pretty easy.
Yeah, go for it.
Yeah. So I guess first one, what's your favorite building if you have one?
Empire State Building. I go there every time I'm in New York.
Yeah. It's funny how now there's a lot of buildings in New York that have the decks. Actually, I think I once dug into this. It's actually a pretty good business. In terms of smart home tech, smart thermostat, others have any favorite gear at your house?
I really like lighting. So I have a fully kitted out smart lighting system. LiftX is the brand, and I love it.
Yeah. I've showed my kids how they can change some lights on an iPad or on my phone. Luckily, they don't mess with that very often, but they think it's cool. Do you, I guess, from a hobby, favorite outdoor activity? I know you're on the west coast of Canada. Things you like to do in your spare time?
Yeah, I'm a bit of an anomaly on the West Coast. I'm not as outdoorsy as some others. My hobby is electronic dance music. So I used to throw.
I saw the DJ stuff behind on the left shoulder of yours.
Yeah, so I'll talk about that anytime you want.
Great. I think we have somebody else for theme music, Lewis.
We had the Chief Product Officer of Tritium, who is also a avid musician. Well, we always put company and guest show notes details in the show notes, shall I say. Maybe we'll include your SoundCloud's playlist in there as well.
Sounds good.
Chris, really appreciate the time.
Thank you so much.
Amazing.
Great to see you.
Thank you very much.